Have you ever traveled to another country and exchanged your money for local currency? That's a basic form of forex trading. Forex, short for foreign exchange, is the global marketplace where currencies are traded. It's the largest and most liquid financial market in the world, operating 24 hours a day, 5 days a week. In forex trading, you're essentially buying one currency while simultaneously selling another. The goal is to profit from the fluctuations in their exchange rates. Imagine buying US dollars with British pounds, hoping the dollar strengthens against the pound. If your prediction is right, you can later exchange your dollars back into pounds at a profit. Forex trading offers an accessible entry point for individuals to participate in the global financial market. With the advent of online trading platforms, anyone with an internet connection and a bit of capital can try their hand at forex trading. However, like any investment venture, it's crucial to approach forex trading with a thorough understanding of its mechanics and potential risks. Before diving into the world of forex trading, it's essential to grasp a few key terms. Currencies are always traded in pairs like EUR-USD, Euro-US dollar, or GBP-JPY, British pound, Japanese yen. The first currency in the pair is the base currency, and the second is the quote currency. When you see a quote like EUR-USD =1.1050 comma, it means 1 euro is worth 1.1050 US dollars. If you believe the euro will strengthen against the dollar, you would buy the EUR-USD pair. Pips are the smallest unit of price movement in a currency pair. For most pairs, a pip is a movement of 0.0001. So, if the EUR-USD moves from 1.1050 to 1.1051 comma, that's a 1 pip movement. Leverage allows traders to control larger positions with a smaller amount of capital. For example, with 50-to-1 leverage, you can control a $50,000 position with just $1,000. While leverage can amplify your profits, it's crucial to remember that it can also magnify your losses. Forex trading involves buying and selling currency pairs through a brokerage account. Traders use various analytical tools and strategies to predict future price movements. These tools can include technical analysis, which involves studying historical price charts and patterns, and fundamental analysis, which focuses on economic indicators and geopolitical events that can impact currency values. When you execute a trade, you're opening a position in a specific currency pair. If you think the base currency will strengthen against the quote currency, you'll open a long position, buy. Conversely, if you anticipate the base currency weakening, you'll open a short position, sell. The forex market is driven by supply and demand. Factors such as interest rates, economic growth, political stability, and global events can influence the value of currencies, leading to price fluctuations. Section 4. Weighing the scales, risks, and rewards in forex. Forex trading offers the potential for significant profits, but it's not without its risks. The market is highly volatile, and prices can fluctuate rapidly, leading to both gains and losses. Leverage, while amplifying profits, can also magnify losses, potentially exceeding your initial investment. It's crucial to have a solid understanding of risk management strategies, such as setting stop-loss orders to limit potential losses. Additionally, it's essential to approach forex trading with a disciplined and rational mindset, avoiding emotional trading decisions. Section 5. Navigating the forex market. Tips for beginners. For those new to forex trading, starting with a demo account is crucial. This allows you to practice trading with virtual money, familiarizing yourself with the platform and strategies without risking real capital. Educate yourself thoroughly on forex basics, technical and fundamental analysis, and risk management techniques. Start with small trades and gradually increase your position size as you gain experience. Don't be afraid to seek guidance from experienced traders or financial advisors. Remember, forex trading is a marathon, not a sprint. Patience, discipline, and continuous learning are key to navigating this dynamic market successfully. Section 6. Conclusion. Embarking on your forex journey. Forex trading, while potentially lucrative, demands a thorough understanding of its complexities. By grasping the fundamental concepts of currency pairs, pips, leverage, and risk management, individuals can approach this global market with a more informed perspective. Remember, success in forex trading requires dedication, continuous learning, and a disciplined approach to risk. With careful planning, strategic decision-making, and a willingness to adapt to the ever-changing market landscape, you can embark on your forex journey equipped with the tools for potential success.